It's been a pretty busy year, and we're going to review some of the international headlines that we've seen in 2015. We're going to provide some insight into how we analyze these events and our opinion on whether these events were more about short-term noise or more about having a longer impact on portfolios. The three headlines that we will focus on are the Greek debt crisis, China's stock market bubble, and the currency devaluation that we saw in China. Now, we're going to go in chronological order. So that means that the Greek debt crisis is up first. And this may seem like ages ago, so let me take a brief moment to kind of bring us up to speed and remind us of what happened. Earlier this year, Greece was unable to meet its debt obligations and needed the assistance of the European Central Bank. In exchange for that assistance, the ECB required austerity measures from Greece. Several rounds of negotiations were had between both parties before a deal was finally made. And this event really occurred from January 2015 to about the early portion of July. Now, during this time, we saw some pretty newsworthy events. We had banks close down in the country of Greece. We had them miss an IMF payment. We saw their finance minister resign from their position. Some of the headlines that we saw in papers are listed up here on this page. Now let's take a look at how markets reacted to some of these headlines. And observation one is we saw a continual rise in volatility, particularly overseas. The blue line here represents the VDAX index, which is a proxy for volatility in European markets. The red line here represents the VIX, which is a proxy for volatility in US markets. Now, initially, the volatility was limited to overseas markets, but as negotiations dragged on, we saw that volatility spill over into the United States. A second observation is that we had a rise in interest rates for countries in other parts of the Eurozone. So here we have the 5-year yields on government bonds for Italy, Spain, and Germany. So the point here is that we had a sell-off in both equity markets as well as government bond markets as investors were concerned over the potential impact in the other countries in the Eurozone. Now, in the midst of this drama, we did some work on evaluating any potential long-term impact. Many of you may recognize some of the upcoming charts that you'll see as we featured them in our webinars as well as our newsletter on the Greek debt crisis from earlier this year. Now, we looked at the entire Eurozone economy, and we found that Greece is a small piece of that economic pie. It makes up only 2% of that region's economy. In comparison, Germany, France, and Italy make up 66% of that region's economy. Furthermore, to offer a little perspective, this is how Greece stacks up to some of the states within the US. The Texas economy is 6 times as large as Greece, and Illinois is more than double that of Greece. So clearly, in terms of economy size, there's little potential for impact. Now let's take a look at direct equity exposure to that country for most institutional investors. Listed here are the major non-US equity indices. The MSCI EAFE represents developed countries, the Emerging Markets Index, and then the ACWI ex-US, which is a combination of the two. First thing to note is that in November of 2013, MSCI, the index provider, reclassified Greece from a developed country to an emerging country, so there's 0% exposure in the EAFE index. And there's only 1/3 of 1% exposure in the Emerging Markets Index. So in Greece, we have a country with a very small economy, a place where institutional investors have limited, if any, direct equity exposure. Now, despite this, in the short term, investor sentiment can impact equity markets, and this is exactly what we saw as it relates to European stock performance. What many in the market were overlooking at this time were improving conditions in this region from an economic standpoint. PMI, which is a common indicator of economic growth, was in an expansion territory. You had inflation and unemployment, though high, they were moving in the right direction. We saw upside earnings surprises from several of the companies within this region. While things were not rosy, the market was underappreciating some of this change. Now, once a deal was finally agreed upon in early July, we saw an immediate pop in equity markets as a recognition of some of that change. So the verdict on the Greek drama, short-term noise, short-term volatility, very much. Next, let's move on to China. So there's two things that we'll be talking about on China: the stock market bubble and the currency devaluation. Listed here are some of the headlines that we've seen in regards to those two events. Now, following the Greek drama, we did have several weeks of relatively calm markets, and I took that opportunity to take my family down to Mexico on a vacation. I did some due diligence on some of the local cuisine, took advantage of a strong US dollar, really went a long way. And, like my vacation, the calm in the markets was short-lived as we saw another spike in volatility on news out of China. This time, both US and overseas markets experienced this spike in volatility as well as an equity sell-off. So similar to what we just did for Greece, let's walk through an analysis on China. And our first major insight on China is it's kind of a big deal. Here we've mapped out world global GDP and some of the major contributors. As no surprise, the United States is the dominant country, representing close to 23% of the world's GDP. China, meanwhile, has a significant portion at 13% of the world's GDP. Now let's take a look at direct equity exposure. China is still considered an emerging market country, so there's no exposure on the developed side of things, but it represents nearly 20% of the EM index. It's the largest country within that index. So clearly, relative to Greece, what happens in China has the potential to have a bigger impact in the rest of the world. Now let's talk specifically about the two events that we saw and about these headlines. We'll start with the Chinese stock market. Beginning around the fourth quarter of last year, we saw increased enthusiasm for Chinese equities, and I'll note three reasons for this. First, in November of 2014, you had the opening of the Shanghai Stock Connect program. And what this did is allowed more equity market participation from foreign investors. Second, you had Chinese officials relax some of the margin standards and really kind of push towards increased market participation. And third, you had the anticipated inclusion of the A-share market into the indices, which hasn't happened yet, but is still on pace to happen. Now, charted here is the number of new brokerage accounts opened on a weekly basis in China, and this really exhibits that kind of growing enthusiasm that we saw. The local stock market run-up was very much a local phenomenon, with the A-share market, that's here marked in red, outperforming the H-share market by nearly 100% at its peak. Let me take a minute to talk about the differences between these two types of share classes. You have the A-share market, which are Chinese companies that are listed on the Chinese stock exchange and traded in the Chinese currency. You have the H-share market, which are Chinese companies that are listed on the Hong Kong Stock Exchange and trade in the Hong Kong dollar. And traditionally, or historically, the A-share market has very limited foreign ownership, as there's been restrictions on that and to who can access that. So most US investors, the primary source of equity exposure from China is via this H-share market. Now, while not all companies are listed on both share classes, there are many companies that are listed on both share classes. And we refer to these companies as dual listed stocks. And when looking at these dual listed stocks, as a result of the run-up, the A-shares are now trading at significant premiums to the H-shares by nearly 50%. Since the launch of China's Stock Connect program in November of last year, we saw that premium really balloon during that time. The key point here is the headlines that we hear about China's stock market are largely based on this A-share class, the local stock exchanges within China. Now, that brings the question on who owns these A-shares. Only 2% of the A-share market is held by non-Chinese investors, and that's shown here on the far left-hand side. This is in stark contrast to some of the other equity markets where you have 10 to 30% foreign ownership as more of the norm. So China owns a vast majority of their own local equity markets, but unlike the US, it is a very small portion of the household balance sheet. The real asset on the balance sheet is real estate for the households. So the dramatic fall in equity markets will have a significantly smaller impact on the Chinese consumer in comparison to what we would see in the United States. The bottom line here is that the foreign ownership in Chinese markets is very small, and the stock market has a little effect on the overall economy as it relates to the consumer. So the stock market bubble was very much about short-term noise, short-term volatility in a still immature equity market. Next, let's move on to the currency adjustment. And on August 11th, China adjusted the way it set its currency rate versus the US dollar. Basically, what it did is it began incorporating the previous day's closing price into the new day's set price. And this adjustment resulted in a 2% drop versus the US dollar in that one day. And this was the biggest downward movement that we've seen in the last 10 years and really took markets by surprise. If you picked up a newspaper on the 11th, you probably would have read stories that included words like market manipulation, currency wars, and hard landing. That would have been in the news during that day. To provide some perspective on this move, we have charted out here the Chinese currency and the euro versus the US dollar, with the euro represented here in the blue line. In anticipation of the quantitative easing program, the euro fell dramatically in the last half of 2014. In comparison, the drop in the Chinese currency has been much, much less. Let's talk a little bit about reactions to this currency adjustment. The IMF called the currency adjustment a welcome step in allowing market forces greater say. Markets, as you know, however, interpreted this action as a sign of economic weakness and interpreted as a way of China looking to boost exports by devaluing their currency. We would disagree with this interpretation. We think that, if you look at some of the data right now, you would see that China, while they had built up their currency reserves, previously over the last 30 years or whatever it is, up until this point, you started to see a decline in their currency reserves. And what that was about is them starting to defend their currency once they freed it up a little bit. So the action of China was quite the opposite in terms of trying to devalue their currency. Now, we would agree with the IMF and see this as a positive step towards allowing markets a greater say in the setting of that currency rate, despite kind of this short-term negative market reaction. The other thing that I would note on currency is that, one of the additional reasons they did this is the IMF is reviewing their currency and taking it into consideration to offer it reserve currency status. So introducing these market forces really increases the probability that the IMF would do that. Now, we've talked about stock market bubbles, we've talked about currency devaluations, but really the underlying concern from investors is the ability of the Chinese government to transition its economy to a consumer-based model. That's really the underlying concern. And the stock market volatility and the surprise currency move has basically shaken investors' confidence in the government's ability to make that transition. Now, China has grown from roughly 4% of the world's GDP in 2000 to 13% over the last 15 years. So it's a more meaningful part of the world and has a more meaningful effect on the rest of the world. Now, we think that a slowdown in China should be expected given its size and the 7% growth rate that it's been at for the last year. But we don't think that a hard landing is probable, and we would expect that over the medium term that China would have a growth rate in the 5 to 6% range. The verdict on China in terms of short-term versus long-term impact, really it's both. Similar to the Greek debt crisis, we think markets overreacted to some of the headlines, and this caused some of that short-term volatility. However, there are some longer-term impacts. The move to implement free market dynamics really does a couple of things. Benchmarks have recognized some of this move, the opening up of the A-share market. They're going to open up the Shenzhen market later this year. And we would expect that looking forward, this would enlarge the investable universe for investors. So we would expect Chinese equities to have a bigger role in different indices for institutional investors. Now, in terms of key takeaways, it's important to remember our longer-term investment horizon and attempt to drown out some of the short-term noise. Headlines are good for selling newspapers, but bad for making investment decisions.